Quants and Code, Renaissance, Citadel, and the Age of Algorithmic Trading. Long Island, late at night. This is not Wall Street. It is an anonymous office park, the kind of place you would expect to find a dental billing company or a regional logistics firm. The parking lot is half empty, the windows explain nothing, and yet inside, the lights are still on. In a large open room, people stare at screens full of code, diagnostics, and charts. Nobody is shouting into phones. Nobody is waving paper tickets. They are adjusting parameters, checking error logs, watching lines crawl across graphs that represent something most of us never see. The microstructure of markets, the tiny patterns inside the flow of orders. In the back, beyond the locked door, a room full of racks blinks softly. Machines hum, talking to other machines many miles away. Messages flash in a language that looks like a noise to humans. Timestamps, prices, volumes, order IDs, cancellations, fills. It is a quiet conversation at a scale too fast for a voice. The sign on the building says Renaissance Technologies. In financial legend, Renaissance is one of the most secretive and consistently profitable trading firms in modern history. And its success rests on an idea that sounded almost heretical when it first took hold. What if you treated markets not as stories about companies and countries, but as data, and you train models to extract small statistical edges the way a physicist extracts faint signals from a messy experiment? Renaissance is the brainchild of Jim Simons. And Simons is not a former Bond salesman with a loud tie and a better Rolodex. He is a mathematician, a serious one. Before finance, he worked on geometry and topology, the kind of work that lives on chalkboards and in journals. He also spent time breaking codes for the US government during the Cold War. That detail matters. Code breaking is not about understanding the enemy's narrative. It is about assuming there is structure hidden inside noise, and then doing the hard, patient work of separating signal from randomness until the pattern reveals itself. Simons later runs a math department at Stony Brook, surrounded by people who think in proofs, not market gossip. Then, in middle age, he does something that baffles academic colleagues. He quits to go trade. At first, he tries to learn finance on finance's terms. He hires market people, he mixes intuition with math, he looks for a neat bridge between the human narrative and the numerical world. It does not go well. The turning point comes when he stops trying to be a traditional money manager and leans into the one advantage he actually has. He hires more mathematicians, physicists, computer scientists, statisticians. People who can talk for an hour about stochastic processes and then casually mention they have never read a sell-side research report in their lives. The message inside Renaissance becomes blunt and practical. Ignore the news. Ignore the stories. Treat the market like a measurement device. Watch prices, volumes, spreads, order flow, and relationship between the instruments. Look for patterns that repeat often enough to matter and small enough to be invisible to anyone thinking in headlines. If you have never worked with systematic strategies, it helps to translate their vocabulary. When quants say signal, they do not mean a prophecy. They mean a measurable feature that, historically, has had a small but persistent relationship with what happens next. A signal might be momentum, the tendency for assets that have been rising to keep rising for a while. It might be mean reversion, where prices that jump too far too fast tend to drift back. It might be a liquidity effect, where an imbalance of buyers and sellers creates a brief mispricing. It might be cross-asset, where moves in one market tend to echo in another because both reflect the same underlying driver, like interest rate expectations or risk appetite. The crucial point is that most signals are weak in isolation. A good signal does not turn 50-50 into 70-30. It might turn 50-50 into 50.2, 49.8. That is the scale. That is why the real game becomes less romantic and more industrial. Measurement, diversification, execution. Measurement means treating data like laboratory equipment. Bad data kills you. Corporate actions, stale quotes, mismatched timestamps, survivorship bias, outliers that look like alpha but are really errors, all of it can manufacture an edge that vanishes the moment real money touches a real market. Diversification means you do not rely on one trick. You combine many small effects across instruments and time horizons so that noise cancels out and the average tendency becomes tradable. Execution means your edge has to survive the world as it is, not the world in your spreadsheet. Transaction costs, bid-ask spreads, slippage, and the brutal fact that the market moves while you are trying to trade it. This is where Renaissance becomes famous, because it does not just build models, it builds an entire factory for converting faint statistical tendencies into trades that still work after costs. Over years, Renaissance builds a system. They collect huge amounts of data, clean it obsessively, and run the scientific method on themselves. Hypothesize, test, validate, stress, deploy, monitor, and kill the model if it degrades. Out of that machine comes the fund that becomes almost mythical, Medallion. Medallion is legendary for several reasons. It trades frequently across many markets, which means it lives and dies by execution quality. It charges fees that sound outrageous by normal standards, and still, historically, it has produced astonishing returns for insiders. And it is closed. Renaissance eventually stops allowing outside investors into Medallion, turning it into something like a private engine for employees and a small circle within the firm. From the outside, Medallion looks like a black box. You hear the performance in whispers. You see the secrecy. You do not see the code. But the secrecy is not just mystique. It is defense. In quantitative trading, an edge is fragile. If too many people discover and trade the same pattern, the pattern gets arbitraged away. Secrecy is not romance. It is risk management. Inside, the culture looks less like a trading floor and more like a research lab. People brainstorm new signals the way scientists propose experiments, but the hardest work is not inventing clever ideas. It is proving your idea is not a mirage. Quants obsess over overfitting, the temptation to tune a model so perfectly to past data that it stops being a model and becomes a memory. They worry about regime change because markets are not stationary. Participants adapt, technology shifts, regulation changes. They worry about correlation spikes, the way strategies that looks diversified in calm periods suddenly move together in stress, like separate boats discovering they were tied to the same anchor. So they build safeguards. They test out of sample, trending in one period and evaluating in another. They stress strategies on extreme days. They model transaction costs to make sure the edge survives realistic slippage. They impose risk limits that look boring on paper, but keep you alive when the world gets weird. And perhaps most importantly, they try to remove the most dangerous variable in a fast system: a human who feels clever at exactly the wrong time. Once a model is approved and integrated, the machine runs it. Humans do not wake up, read the headline, and override the algorithm because they have a hunch. If humans intervene, it is because something is broken, or because the environment has changed enough that the model's assumptions are no longer safe. And even then, it is done through process, not adrenaline. That is the quant philosophy in its pure form. Not I know value when I see it, but I can measure a pattern, test it, and size it so it survives contact with reality. Chicago, New York, London, Hong Kong, Citadel. If Renaissance is the monastery of quant legend, Citadel is the metropolis. Founded by Ken Griffin, who famously started trading convertible bonds from his Harvard dorm room, Citadel grows into a multi-strategy giant that feels less like a single brain and more like a federation. Citadel runs teams in many styles. Some are fundamentally driven. Analysts reading filings, building models of companies, calling suppliers, meeting management. Some are systematic. Researchers mining data, building signals, trading with algorithms. Then there is Citadel Securities, a market-making powerhouse that stands between buyers and sellers, quoting prices in thousands of stocks and options every second. To outsiders, Citadel can feel like two eras stacked on top of each other: the old world of discretionary judgment and the newer world of machine speed execution. That duality matters, because the future is not always humans disappear. Often, humans move up a level. Less manual clicking, more system design. Less trading as performance, more trading as engineering. As electronic trading replaces floor trading, markets start to resemble continuous auctions run by computers. The core mechanism is the central limit order book. Orders appear, get filled, get cancelled, and the book updates constantly. That digital structure creates a new kind of competition. If you can respond to a market data a few milliseconds sooner, you can repeatedly end up on the right side of tiny price movements. Not because you have predicted the future like an oracle, but because you have reacted to the present with less delay. For ordinary investors, this shift is often good. Spreads have tended to shrink, transaction costs fall, liquidity, most of the time, improves. For algorithmic traders, it opens a battlefield where details becomes destiny. Queue position, which order gets filled first, how exchanges prioritize orders, how rebates and fees influence behavior, how venues interact, how latency gaps create temporary arbitrage. So, firms invest in infrastructure. They co-locate servers near exchange data centers. They optimize network paths. Some build dedicated fiber routes, not because they love cables, but because in a world where microseconds matter, physics becomes part of finance. The speed of light turns into a business constraint. It sounds absurd until you realize what it really means. Markets have become an arena where information arrives, gets priced, and gets acted on at machine speed. If you are slower, you are the one being acted upon. From a distance, this world looks inhuman. No one can consciously track thousands of orders and cancellations per second. No one decides at that time scale the way a human decides to buy a house. Yet the algorithms are still written by humans. They embed assumptions, simplifications, and blind spots. And one of the biggest systemic risks is not that a single algorithm is wrong, it is that many algorithms are similar. In August 2007, something strange happens. Quant funds that are supposed to be diversified and uncorrelated start losing money at the same time. Strategies that usually generate small, steady gains suddenly drop sharply over a few days. Inside those firms, it feels like the market has changed its rules overnight. This episode, often nicknamed the Quant Cake, becomes a cautionary tale. When many funds chase related signals, they can become crowded into the same trades. In normal times, that crowding can stay hidden, because small differences in implementation disguise the underlying similarity. In stress, when everyone tries to reduce risk together, liquidity stops behaving like a stable substance. It becomes a disappearing floor. Then, in May 2010, the flash crash gives the public a glimpse of another fragility. US indices plunge and rebound within minutes, shaped by a chain reaction of orders, cancellation, and liquidity withdrawal. Investigations debate specifics, but the lessons that sticks is simple. The market can now move in ways too fast for human comprehension, and the interaction rules between automated strategies can produce dynamics that feel alien even to experts. The system is still made by humans, but it runs in a regime where human intuition has limited real-time authority. For firms like Renaissance and Citadel, the rise of machines has been a bonanza because they embrace complexity instead of fearing it. Every new order type, every regulatory tweak, every market structure change becomes something to measure and model. But over time, the edge gets harder to maintain. Competitors copy, exchanges adjust rules. More players chase the same micro edges. Even physics sets the limit. Once everyone is co-located and optimized, you cannot outrun the speed of light. So the competition shifts toward prediction quality, execution discipline, and risk control. Still, one reality remains. Modern markets are, to a large extent, machines talking to machines. Humans sit above, designing, monitoring, intervening when something breaks, but the day-to-day functioning is algorithmic. Prices are often less the result of two humans arguing about value and more the emergent outcome of many automated strategies interacting under shared rules. And that forces an uncomfortable question that sounds philosophical but is actually practical. When a system becomes this fast, does it become safer because it is measured and disciplined? Or more brittle because the interactions are too complex to anticipate? The honest answer is both. Machines can reduce certain human errors, like panic selling on a headline. They can also create new failure modes, like feedback loops that amplify short-term moves. Progress is real, so is complexity. Quant finance also offers a seductive comfort. It feels rigorous. You can point to backtests, confidence intervals, stress scenarios, value at risk reports with careful decimals. You can simulate thousands of possible paths and reduce charts that make uncertainty look domesticated. But history is a short sample of a long possibility space. Models are built on patterns that existed under market rules, that existed among participants, who existed in a technology and regulation environment that existed. reality does not promise to repeat on schedule. So the mature version of quant thinking is not blind faith in the model. It is humility about the model. The best firms treat models as tools, not truths. And they build monitoring systems to detect degradation, crowding, and regime shifts early enough to matter. In a strange way, that is the responsible takeaway. Machine trading does not eliminate human responsibility. It changes what responsibility looks like. Less, trust the trader's gut. More, trust the designer's discipline. What you choose to automate, what you refuse to automate, and how you build breaks into the systems that want to run. While quants refined their machines, another story was unfolding on a slower, heavier scale. In the early 2000s, low interest rates, global capital flows, and political choices inflated housing bubbles in several countries, especially the United States. Banks and investment firms packaged mortgages into securities, sliced them into tranches, stacked them into more structures, and sold them with confidence that came partly from ratings and partly from the belief that national housing markets do not fall everywhere at once. Day to day, the machines kept trading. Spreads moved a little, indices ticked up and down. The microstructure looked smooth. Underneath, leverage and exposure were building in places that did not feel like the market, because they lived inside balance sheets, short-term funding agreements, and assumptions about liquidity that only get tested when everyone tries to exit together. One of the firms at the heart of that older architecture was a 158-year-old investment bank. It was not primarily a quant shop. It did not have a secret Medallion-like fund. It had history, pedigree, and a name carved into glass and stone. Lehman Brothers. The age of quants and algorithms shows how far finance has come in turning markets into measurement, and in many ways that progress is real. But the crisis that crested in 2008 is a reminder that the biggest risks are not always hiding in the last decimal place of a model. Sometimes the biggest risk is structural. Who owes what to whom? What collateral backs the promises? And what happens when confidence evaporates? Next time, we step out of the climate-controlled server rooms and into the crowded corridors of Lehman as the housing market unravels. We will watch how a firm that survived wars, panics, and decades of change was brought down not by a high-frequency bug, but by slow-motion failures in funding, mispriced risk, and the sudden realization that liquidity is not a feature. It is a fragile agreement.